Hit the recording button. We are starting off. So today we're gonna go ahead and pretty much cover like a zero-day exploration sniping masterclass for SPX. And this is a very particular, like explicit guide that's created based upon my beliefs. Like it might not be correct. Like there's a lot of people online that are gonna say like, zero-day exploration is gonna blow everybody up. It's the worst thing you could do. But honestly, like I think a lot of people that say that just say it because they haven't been successful with it. I know a lot of people that are very successful with like SPX zero day expiration. Even Demslayer in Owls, like he's a freaking beast with zero day expiration. And I bet you the people that are really good trading zero day are actually terrible swing traders. And I'm one of those people. Like 80% or 85% of all my trading profits come from SPX zero day expiration. And then whenever I swing trade, I lose all of my profits that I made from zero day expirations, and then I have to make it back again trading zero day expirations. So I think the world has changed a lot. Previously, before options dominated the market and before zero day expiration contracts came out, the market would move based off of buyers and sellers. If you think that the market is moving because of buyers and sellers today, and like that's the one-dimensional reason that the market moves, then you are being very, very misled. And I'll go over a lot more in detail with regards to why price is actually moving the way it does today, okay? So first thing first, zero-day expiration is less about predicting the direction and is less about reacting to what price is already doing. Ultimately, it's about exploiting the dealer's reflex. A lot of people probably did not read the Greek's Bible that I posted yesterday night yet. If you didn't, after the session, go read that. A lot of this will make a lot more sense, okay? So I'll repeat that again. Trading zero-day expiration successfully, it's less about predicting direction, it's less about understanding where buyers and sellers are. It's about exploiting what the dealers ultimately have to do to make sure that they remain neutral on their books, okay? Um, we're gonna go over the details of that, but ultimately, like for people that are very, very new, I'm gonna go ahead and refer to it as zero DTE, which is 0 days to expiration. That's what it stands for. And Renee, yes, this also applies to SPY. You could trade SPY like if you are more like or less risk tolerant. Like SPY is a lot cheaper, and the theta just doesn't pack as hard as SPX does. So no worries. And everybody that's saying like you lose all your profits at SPX and make it back in one swing, like don't worry because after the session you're gonna be able to make money on swings and you're gonna be able to make money on SPX. So it's gonna be a double whammy. Like I'm gonna clear up pretty much every misconception you have today. So, the zero-day expiration options for SPX, they all expire on the same day, sometimes within a few hours, sometimes within a few minutes, depending on what time of the day it is. And they're very, very unique in terms of how they trade. The reason is because there's barely any time value left, which means that there's not as much theta cushion. And what this means is that, like, if you're wrong, like, it's just going to lose value immediately. It just happens really, really quick. Right. Tucker's note taker otter is requesting to record this meeting. Yeah, I'm already recording this meeting, so you guys don't have to record it separately, okay? All right. And every cent of value for SPX contracts, they come from intraday movement. Like there's no overnight moves that are gonna matter because like it's all happening before the end of the market trading day, okay? Which ultimately means that they purely trade off of gamma, okay? For people that don't know what gamma today is, the two important Greeks are gamma, which is how fast delta changes its price moves, and you guys should all know what delta is. If you trade options and you don't know what delta is, then like I think you have to do a little bit of soul searching and you have to do a little bit of studying, okay? But gamma is how fast delta is going to change per $1 move in the underlying. Theta is how much time value decays every day, okay? So because zero-day expirations pretty much have no time left, they purely and almost all trade off of gamma and very, very, very little theta at this point. Pretty much what this results in is delta always reacting incredibly violent to even the smallest price changes, because it's very, very sensitive. And then on the flip side, dealers have to hedge every tiny move. Like even the microstructure and the micro movements, like the dealers are constantly adjusting their hedges to remain delta neutral, on their books. And because of that, it creates very, very rapid like feedback loops. So like just remember what I'm saying, and like this might kind of sound like crazy right now because you might not have as deep of an understanding, but like I will break it down like little by little afterwards, okay? So one really, really good analogy for like trading like zero day expiration that I like to use is that it's like driving a Formula One car. Um, it moves incredibly quick. It can turn instantly on a dime at any given point. And on the flip side, it can also crash easily if you oversteer. So it just requires like very surgical precision, and your timing has to be like really, really good. Like trading SPX successfully is almost like using a scalpel. And a lot of people might understand like when you, yeah, vol stands for volatility. Yeah. So pretty much for people that follow people that trade SPX zero to expiration, like for people that follow Dem Slayer, for example, like you might notice that he's gonna enter a trade, he's gonna post it, and within like seconds, like he will post a sell alert for like 35% or 45%. Like the reason he's able to do that is because that's how fast SPX moves. Like there's just so much velocity behind the move, and the dealer hedging feedback loops are so crazy that the premiums just whipsaw very, very fast. He doesn't trade using Heatseeker today, but I just gave him access to it today, so he's gonna go ahead and start using it going forward. And he'll give us some feedback with regards to how he's liking it, but I think it supplements his style really, really well. So that pretty much covers like how the gamma and theta interact with each other to ultimately like adjust and change like the premium prices on SPX. Long story short, like we call it pure gamma because the options price movement is dominated by gamma, which is ultimately an exponential multiplier in terms of the premium contract. Like gamma is an influencer on delta, so because of the gamma spikes that you get when like spot price moves up like crazy, like that's how you see SPX contracts sometimes going from like $1 to like, $3 within like minutes. If you're trading like a 3 day expiration or like, a weekly or like, 3 months out, like this is going to be a completely different ball game. Like it's just a completely different instrument entirely that you should be very cautious of. So going back to like why we cover zero day expiration and why people like it so much. First thing first, like it's very, very lucrative. Trading like zero day expiration is very lucrative. And what I mean by that is that it's pure convexity. Like the payoffs are like explosive. What that means is that if you get caught on the wrong direction, like your loss is also going to be just as explosive. Like you're going to find out very, very soon if you're gonna lose a trade or if you're gonna win a trade, okay? So for people that have a personality like me, where they don't like to wait, 7 days or like 3 months to find out if they were right or wrong on a hypothesis, zero day expiration is a good option. This is contrary to what a lot of people online say, but I really think this is more of a personality fit kind of thing. Like if you're one of those people where you're like, yeah, I don't really care, like I want to give it like 7 to 10 months before I find out if I'm right or wrong, like you can go swing trade. That's fine. You don't need to trade zero day expiration. But zero day expiration, like you literally find out if you're right or wrong, like pretty much within like minutes or like an hour. So that's why I like it. Like I just don't like to like dwell on a trade and like wait for a trade to play out because like time is the most valuable asset in my life. And like if I have to spend so much time just to monitor and keep an eye on something, like I'm literally burning money watching my swing trades play out. Okay. Um, So the dealer reflex is pretty much what makes zero day expiration very lucrative and like a lot easier to trade these days. If we can understand how dealers need to hedge and maintain their books as neutral, we have a lot more predictability in terms of how SPX is going to move, ultimately leading to us being able to understand how we can go ahead and snipe the most profitable trades. If we can anticipate when dealers are going to be forced to buy or sell shares of the underlying or features, we have an opportunity to front run that reflexive nature of how dealers hedge. Okay. Like that's going to be the biggest key point that I'm going to teach everybody today. Um, SPX zero DT, like one other benefit is that it trades pretty similar to like futures. Like it's deep, fast, and scalable in the sense that it's very, very high liquidity and it has very, very tight bid and ask spreads. So your slippage is not going to be as crazy as trading a ticker like, CoreWeave or IREN. And it's very rare that you'll lose money just because you get filled on the wrong side of the bid and ask. Okay. And last but not least, there's no overnight risk because you start the day and you end the day flat. What this means is that you start at zero and by the end of the day, like you've already closed all your positions for 0 day expiration. So if anybody hates overnight gaps or if anybody struggles to like sleep at night because they have a whole book of swing positions open, trading these are good. Like when I used to swing a lot more often, like you wouldn't believe it. Like my sleep quality would be so terrible because I would constantly wake up to see what's happening in global news and like I would just keep on checking futures and like I literally hated it. Like it's terrible. And like, if you're in the same camp as me, like 0 day expiration trading is for you, you know? All right. So I go over all the I go over all the pros of trading 0 day expiration. Like I have to go over the cons. Like I like to keep it a buck. Like I'm gonna be very, very honest in terms of every thought I have. And for every pro, there's always gonna be a con. Many of you guys might already know these, but for the sake of covering it, the flip side of trading 0 day expiration is that the decay speed is very, very fast. Like the premiums decay like incredibly rapidly. What that means is that 0 day expirations, they can literally lose like half or like 90% of their value in minutes. This can happen if you're chasing a move and then you enter and the price reverses. It can happen if you enter and like price remains flat. It can happen if you enter and price goes down. It can also happen if you enter and the price is going up, but volatility in the VIX goes down. Because what that means is that naturally your delta is going to decay because of the volatility drop. So what I call is like, DK speed is like one big con of it. The volatility to crush is another con of it, which means like if you chase a move during like high volatile regimes, then, even if the price does move in the direction that you're going in, because of the volatility crush, like your premium will effectively evaporate. There's also a very big risk of whipsaw, like whipsaw risk, which means like, your premiums can pump to like 120%, and all of a sudden, because a quick reversal, like it could go down to like 30%. Like this is why when you're trading SPX 0 days, you don't want to be super greedy. Like I tell people to be very vigilant with taking profits. And if you have a little bit more tolerance for risk, what you could do is you can go ahead and you can leave runners all the time. Oh, no, I'm not sharing my screen right now. I'll go ahead and share it soon when I start going into TradingView and when I start going um, into the heat maps themselves. All right. So, 0 day expiration, like my Eli 5 explanation for it is like it's like nitrous in a car. Like I don't know if people remember the Fast and Furious days, but like you can literally press like the NOS button and then you just freaking go crazy fast, right? And then your portfolio is gonna cross and go a lot faster than like, your other peers that are not trading 0 day expiration. At the same time, if you push the button at the wrong time, like while you're going through a turn or like over slippery slopes or something like that, you're ultimately gonna spin out. So. Um, yeah, it's a big risk and big risk and big reward kind of thing. Okay. So that pretty much covers like a lot of my thought process with regards to like 0 day expiration conceptually. Um, I'm seeing a lot of chat. I'm gonna ignore a lot of these initially because like I don't want to break the flow of the conversation, but thank you everybody for um, answering. Okay. So I'm gonna go over like the mechanics of a 0 day expiration play, and also like by the way, like during this conversation, like I like to just speak what's in my brain because I don't want to sound like I'm just reading off of a PowerPoint. Like I do have a document, and like I'll go ahead and share it afterwards. But ultimately, like I want this to be more dialogue oriented, so it's just coming from like literally what's in my brain because I want you all to know exactly what my thought process is as I'm trading, not something that's just explicitly written on paper as part of a guideline. Okay? So generally, like I'm gonna go ahead and talk about my daily cycle when I trade 0 day expirations. Like I have a firm belief and like there's a high probability that mornings are meant to be traps. So like the 9:30 a.m. to like 10:30 a.m. Eastern time frame window, like in my opinion, those first 15 minutes to like 45 minutes to an hour are very, very trappy. Okay? I call it noise and I also call it like whipsaw. And the reason that's happening is because when the market opens, options are effectively repricing instantly. So the options reprice based upon like overnight price, based upon like the theta kick that you incur over the night. And because of that, the overnight delta and gamma exposures are shifting, which results in dealers having to rebalance their hedges to remain delta neutral. Okay, this is the most important part, and this is why I always say trading the first 15 to 30 minutes of the market is very, very risky. Like it's the time frame where all of the rebalancing is happening due to the overnight delta and gamma exposure shifting. Not only this, there's a lot of scientific papers like I researched and looked into, and 80% of options selling and dealing happens within the first 30 minutes of market open. So what that means is that like if you are not fast and really, really experienced, there's a very, very high probability that you're gonna get trapped in the first 30 minutes. Okay? So just be very, very careful. All right. So you could pretty much think of it like stretching a rubber band in the morning. Like the market is effectively just snapping back to where deltas need to be after the open. Like all of the rebalancing from the overnight moves is happening during the first 30 minutes. So just be very, very careful. And the takeaway from this is that like the true direction really comes after the morning reset happens. Okay. So I know some people like they wake up in the morning, like they see the map, it's super clear and like, they still do good, but like you have to be quick and you have to be very careful of shifts in direction or reversals because there's going to be a lot of traps for sure. Okay? In my honest opinion, like I think generally between 10 a.m. to like 11 a.m. to like 11:30 is like a really, really good time to trade because at that time, it becomes a lot more clear with regards to what the rest of the direction for the day is going to look like. And you don't have as much like reshuffling unless there is news or unless there is like a binary event or, some kind of Trump tweet that might kill everything. Volatility will generally also kind of slow down, like, towards like midday. So it becomes a lot more predictable if you want to go ahead and like trade reversals or fade the edges. But ultimately, like, after the first 30 minutes, that's when I'm really, really dialed in. And like, that's when I'm looking for like good setups for how I'm going to trade the rest of the day. All right. And then during the lunch hour is like another time frame where it's like, you want to be a little bit more like skeptical. Like first thing first, like there's not as much liquidity like during the lunch hour because not many people are trading during that time. Like people are out for lunch. Naturally, like you just don't see that much happening. And like this doesn't mean like you shouldn't trade during the lunch hour at all. It just means that due to the thin liquidity, like there could be a lot more expansion in terms of manipulated like price movement. So that's generally what you want to be very careful of. And then towards the end of the day, like 3:30 to 4 p.m., I call this the volatility unwind. Ultimately, what you see between 3:30 and 4 is the Robinhood auto liquidation and the expirations. So generally, when that happens, if gamblers in the market, which are like the players that are on the opposite side of dealers, are getting closed out, the dealer hedges are effectively unwinding. So final expiration hedges unwind. This means that dealers have to flatten Delta and Vega before the close. And generally, like, you just see like you could see pretty aggressive movement in either direction. And ultimately, it really depends on volatility. Like if volatility is spiking very sharply into the close, like dealers have to chase hedges a lot more aggressively, which means that you get a very, very fast like rug pull type of movement. If the volatility is more stable, what you get, generally speaking, is like a final melt up into the close. So because dealers are having to close out their positions, like you generally just get like a slow melt up. And on the flip side, like if the volatility spikes, you're going to go ahead and get a rug pull because the dealers are forced to continue selling to neutralize their positions. Okay. So a lot of the key takeaways here, like generally, like I don't recommend opening fresh trades in the first 15 to 30 minutes. Like if there's something like very, very clear and obvious, like you can, like just be prepared and just be aware that like there could be traps and you could get caught in a reversal and you might be fucked. So, you could trade a little bit smaller size, I guess, or just be like very vigilant with how you're sizing. Like that's the most important. All right. So going into how you can go ahead and snipe 0 day expiration moves. Um, Step one, like what I generally do and like what I recommend all people to do is like if you're gonna trade SPX, especially for 0 days, you can't just trade on the SPX map alone, okay? Like you have to look at SPX, you have to look at SPY, you have to look at QQQ, and you have to look at the net GEX, and then you sometimes even have to look at the net VEX And the net vex, like the reason you have to look into it is because if the VIX or if volatility is spiking, there's a lot of times that even for a 0 day expiration or like 1 day expiration, we start entering a Vanna controlled regime. So like, even if there's a Gex floor saying like, yeah, SPX should bounce in like the next 5 points, like if you're getting a volatility spike as the price is dropping into that floor, we can significantly overshoot it and get a rug pull down even further from where that is, which is ultimately going to end up with you getting caught off sides, right? So that's something you have to be very, very careful for. Um, so first thing first, like just make sure that SPX by QQQ is kind of all in alignment in terms of like, the Gex and the Vex. And identify like where the major like exposure levels are and like the flip levels are. So for example, if you see like SPX has, a Gex, like a major Gex king node, like, 10 points to the downside, but if SPY is showing like a major node like much lower below that, then like you should be a little bit cautious of buying the floor on SPX because the SPY could end up like it can result in a sell loop, especially if volatility is spiking. And what you're going to end up with is SPX actually flushing below that negative Gex level, and you're just going to end up in a rug pull situation as well. So um, generally, like if you're gonna fade the edges or if you want to go ahead and buy like a floor, in low volatility regimes, like you can go ahead and trust the Gex and like just buy it off of the floor. But if the volatility is high, like you have to just keep an eye on like how much lower it can go from there. And like volatility high doesn't mean it's going to flush below it and keep on flushing below it, by the way. Because what happens when the spot price drops below your major like, Gex King node is that the puts that the buyers, which are the players, are holding, they go in the money, they generally cash them in. Like how long do you wait? Like like somebody should tell me like how many times have you actually let an option contract for 0 day expiration go in the money and you literally held on to it? Like that shit is very, very rare. Like generally, like if something is almost nearing at the money or in the money, like you generally are gonna close it. So what that results in is as the players who are once holding those puts are cashing in, the dealers have no longer need to remain short of the underlying. So what they end up doing is they end up covering and buying them back, which is why you generally get the V-shaped reversals from like the major negative Gex puts. Okay? So yeah, and even them, like the thing is, like he's not going to hold all of his contracts until they go in the money. Like he's generally going to sell a lot of them like as it approaches, and then he's going to go ahead and hold runners, and then if they end up in the money, like it's just an additional bonus. Okay. So like there's a lot of other examples that I can go ahead and share, but the setup that I'm going to go ahead and cover today, like on TradingView and on the heat map, is how Friday played out. Okay, like I'm gonna go ahead and share one example. It's gonna be from Friday, and this was an example of SPX dropping down towards a negative Gex pit. And let's go ahead and walk through how it happened. Okay, let me just pull up my screen share. Alrighty, so everybody can see this, right? All right, so for anybody that has access to the Skylight.ai, you can go ahead and click this replay function. We're going to go into SPX. We're going to go into 07, which was yesterday. So let's go ahead and look at this. Like right off the bat, like right at 4 a.m., like even pre-market, like you already noticed that the key nodes are down here at 66.40 and 66.30. So like that's almost a 90-point drop from where we were at the highs. And like that is a really, really good potential trend day down to the downside, okay? Not only this, let's go ahead and look at what SPY was looking like. SPY on the same day, if you look at it, hold on just a second. So even if you look at SPY, I believe there was so if you look at the SPY, there's a 670 node and then the next VEX node is down here at 660. Like throughout the review that we're gonna go ahead and do, I will go ahead and show you how this was like changing through the day, okay? So going back to SPX, let's go ahead and take a look at this. Generally, if you look at something like this, like I think this is all in Eastern time, by the way. Um, So this is market open. You're at 6,700. So right off the bat, if you look at this, like your range for the day on SPX is 6,700 to the upside because this is the peak positive node. Generally speaking, there's a high probability that it goes up and then it rejects to the downside right here. Um, and what I look for in terms of zero day, like this is actually what I look for in any kind of trade setup, okay? You want to have at least a 3-to-1 risk to reward ratio, okay? It's a 3-to-1. If it's not a 3-to-1 or greater, you shouldn't even consider or look into the trade unless you are an absolute monster at scalping and you're able to maintain a win rate of at least 80 to 85%. Okay? Like I can maintain a win rate of 80 to 85%. Like I think a lot of other SPX traders can also maintain that. But, unless you're able to get surgically precise to be able to trade with those kinds of numbers, you should always be looking for a 3-to-1 risk to reward. That way, even if your win rate is only 50%, because your winners are 3 times larger than your losers, you're gonna have a profitable career, okay? Like this is very, very important to keep in mind. So the current price is at 66.90. The upside major king node is at 6,700. This indicates that there's 10 points of potential upside, right? Now, the major nodes to the downside, the key node is all the way down here at 6630. You've got one here at 6640. Like, let's average down and say, okay, 6635 is going to be like your potential downside target. 6635 is 55 points below where we're currently at, okay? Now, somebody do some basic math. Is this a 3-to-1 risk to reward or is it, what is it? Yeah, it's a 5.5 to 1. Just making sure everybody knows math. And I also had to drink a sip of water. But yes, this is a 5.5 to 1 risk to reward ratio trade. This is really, really good. Any day of the freaking week, you take something like this, okay? And like, sure, like you could say like, okay, market just open. Like, how do I take that? But like, a trade like this for me is worth it. If I can get like a 5.5 out of 1, like even if I'm wrong on this trade, like I'm okay. And I'll just be like, all right, well, it was worth a shot and I took it, okay? Now, even as the day kind of evolves, like, let's actually see how it played out. So 9:32. Like it just keeps going down, right? Just gonna keep going through. All right, so pretty much like as you're seeing throughout the day, like it was always kind of like at the ranges always remain the same. And what I mean is that, this is one major one, this is a major one, and this is a major one, okay? Okay, I'm confused. Is that not a 5.5 to 1? All right, I'm about to boot this dude. All right, yeah, I'm gonna boot this. Yeah, I'm gonna turn off the chat while the session is on. Sorry, I keep on getting distracted. Like I try to answer questions in real time because like I just want to make sure that people are catching the concepts, but I'm just gonna go ahead and ignore it because apparently there's some weird people in here. But anyways, like we're running through the map and like you're just gonna see everything happen, okay? So generally like just based off this map alone, like the risk to reward kind of makes it worth it. And like when it gets down to like the 6640, like one thing that I say is like, there's the concept of a GK node, which is like a gatekeeper node. So what you're gonna do is like, you've got this potential one right here, which means that there's a ton of open put positions here, okay? If there's a bunch of open put positions here, what that generally means is that the dealer is going to be plus delta on this position, which means that they have to be short of the underlying in order to remain neutral on the position, okay? Now, what's going to happen is the price drops down into 66.40. There's going to be a lot of traders that end up with their puts being in the money, and the delta gets closer and closer to -1, meaning that the dealer like no longer has to hedge for that position anymore. Naturally, like what happens as an effect of that is that like they don't have to keep on selling shares of the underlying for this particular strike, okay? They still have to do it for this strike. They don't have to do it for this one. So what I would expect if I saw something like this is a potential mini bounce here due to a lot of the players and the gamblers cashing in on their puts resulting in dealers being able to unwind a lot of those shares that they initially shorted. And it's probably going to result in like a little mini bounce. And then ultimately you end up going down again. Like that's kind of how I'm thinking about it. So if anybody has taken this trade, like you would be scaled out in at least partials by the time you hit 66.40. And if you really wanted to, you can go ahead and try to hold runners until 66.30, but you don't want to be holding it if it gets above these two negative ones right here. If it gets above these two negative ones here, you're going to end up in a rough buy loop and you're going to get caught in a squeeze, okay? So that's kind of like clarity on where your stop loss should be. So let's actually see how things played out here. All right. So yep, you see that bounce right there, right? It bounced up to 66.50 from 66.40. That's almost a 10 or 12 point bounce. Like even if you took calls there, like you took like 30 to 40% of that trade, okay? But ultimately it just goes down and then it hits 66.30, okay? So that's how you saw everything. After that happens, like, it bounces back up. The floor gets stronger at 66.40, and then naturally what you're probably gonna get is like a squeeze towards the end of the day. See, remember earlier I said if it crosses above 66.50, 66.55, you want to be very, very careful. You don't want to be stuck in that anymore, okay? So at that point, you should all be out of puts already, right? And then it literally just goes. You see the 6,700 accumulating up here? Like that shows me that calls are being bought, and then you're ending up with positive exposure up there. All right. So I went over. Yeah, I see a lot of messages in the chat. I'm gonna go over the trading view real quick, and then I'll go ahead and answer questions afterwards. Okay. So let's go ahead and see. Like you saw pretty much how it played out. Like it was at like 66.80, came down to 66.40 and 66.30, and then it went back up. It crossed these nodes, and then you got a ma major squeeze, right? Let's go ahead and see how it looked on the chart. All right. So generally, when I'm day trading, I usually go to the 3 minute chart. Like the 3 minute chart is my bread and butter. Earlier, let's go ahead and take a look. Like beginning of the day, we had 66,700 right here. And then we had the 66.40 right here. And then we had 66.30, okay? Um, so one thing to note here. In the beginning of the day, you saw 6,700 as a major. You saw the 6,700 come back to life towards the end of the day. What that means is that either the existing 6,700 positions never closed out and the deltas grew as we started to reverse, or it could mean new positions were placed at 6,700, or it could mean a combination of both, okay? So even if a 6,700 node diminishes, like you don't have to automatically assume that all of those positions are closed out. What it means is that the deltas have reduced in size because the price drifted so far away from it that the exposure is a lot lower than it was earlier in the day when price was closer to that level. That level can easily come back to life, okay? Like this is kind of why it's important to like just keep an eye on like what the major levels on the day are, because a lot of times after a reversal, a level that was there in the morning will easily come back to life. You will see this on SPX, you will see this on SPY, okay? Shriram, you gotta ask me like what I needed to repeat because I just covered a lot of shit, so I'm not entirely sure what you're asking me to repeat. All right? But, if we've got the negative exposure at 66.40 and 66.30, like the immediate thing that I'm already thinking about is that my buy zone for calls is going to be anywhere from 66. Like I'm going to draw this zone and I'm going to be like, all right, I'm going to go ahead and buy the dip here, okay? Generally, when I am trading SPX, I trade based off limit buys. Like I don't trade market ever. And what I'm doing is I know that as the 66.40 puts and the 66.30 puts go in the money, the players and the gamblers are actually going to start closing those positions out, which is ultimately going to lead to a buy feedback loop. And what I try to pair that with is what I try to pair that with what the VIX is looking like, okay? So this buy feedback loop in like you want to make sure like volatility is not spiking as this level is being hit, okay? So like, you got like 1206 right here. Let's look at what the VIX looked like at 1206. Right there, okay? So I like not everybody has to use this, but like I have a reversal indicator for like the VIX that I particularly use where the hollow candles just means that it's overheating and it's a likelihood of it eventually getting exhausted. So for me, like the point of confluence that I had right here is that like, the VIX was looking exhausted as we were approaching like that major 6630 and 6640 level. So when that happens, I'm like, all right, like that's a signal for me to buy. Not only that, like for people that have access to the glitch dot, you would know that like the additional confluence layer is here where you get a buy signal right on this candle. And like you should be in like within this range at the bare minimum. Um, so effectively, like what you do is as it approaches the 6640, you place a limit buy because as it's tapping into the 6630, you already know that the 6640s are going to start unwinding because people are cashing in on their puts. And even as it gets close to 6630, you're going to get like double the people cashing in. So you're going to end up in a potential reversal level right here. When you set a limit buy, what you could effectively do is like just go to the SPX 0-day expiration contract, look at what the bid and the ask is. And like if the bid is at like $2.30, for example, like what I'll do is I'll put limit buys at like $2.15 or
I
2.10
haven't got like a
to try to lowball
small.
the move. All right, who unmuted themselves? Hold on.
Yeah, I haven't got a small in a while.
All right, everybody's muted and you guys can unmute yourselves now. All right, anyways, so I would set a limit buy and like I lowball the offer. The reason I lowball the offer is because like people often panic sell into red candles, and when you're getting people panic selling into red candles, you've got a great opportunity to actually buy options off of them for very, very cheap. Okay, so that's generally like why I do limit buys. Like if I have full confidence that the price is going to reverse at 66.30, then I'm gonna go ahead and lowball and try to buy from somebody who's gonna panic sell, right? So, what happens when you set a limit buy and you get filled though is that right as this reversal happens, like even after this wick happens right here, like you're immediately gonna be up like 15 to 30% on the trade, and you're pretty much chilling. Like you're chilling in the sense that like your drawdown was near zero. Like the whole goal for like 0-day expiration day trading is to keep your drawdown as little as possible. Because if you have deep drawdown, like it's just a shitty feeling. Like you don't want to be down like 30 to 50% as soon as you enter a trade, right? Which is why being able to snipe these reversals is like really, really important. If you want to be able to snipe the reversals, like a lot of people today, like what they effectively do is something like this. Like they will draw a stupid trend line like this, and they'll be like, okay, like I'm gonna go ahead and buy into these calls after the trend reversal happens, right? So effectively what you see them do is like right when this breakout candle happens, like that's where they're gonna go and enter, right? By the time these two green candles already happened, you are probably chasing a 30 to 50% move on the options premium, bare minimum. Okay? And then from here, if you get this pullback right here, like you're already in the red. But if you enter here, what you could effectively do is on your chart, like just look at the previous breakdown levels. Like, you've got support there, you've got support here. What that effectively means is that this is going to become a pivot flip because it's a level that price broke down from. And naturally, as it goes back up into it, there's going to be a very, very high chance of it rejecting there. So, long story short, like you should be out of most of your positions here already. If you want to go ahead and hold through, you would hold through as long as this low holds. If this low of the day holds, you hold. Or if you want to be a little bit more conservative, what you could do is you can hold as long as the golden zone retracement here holds, which is the 61.8 to the 79% Fibonacci retracement, okay? As long as this holds, like this is a bullish reversal, meaning the next leg up from here will go higher than the previous leg, okay? Like that's just the whole law and nature of like how Fibonacci retracements work and how trend reversals work, okay? So that is effectively like how you can catch a reversal here. Um, and just as I mentioned earlier, like on the heat map that we saw, like we had some exposure here at like 66.55 and 66.60. Like once that breaks through, like you're pretty much off to the races and like you just get squeezy action from there. Okay. So that pretty much it covers like the art of sniping the reversal. So I guess we've got that. I think somebody asked like how can we check if there's a probability of further downside from 6630? Like there's no absolutes in the market. Like I think a lot of people are looking for absolutes, but like trade-off of probabilities and precise execution rather than looking for like 100% absolutes. Okay, like that's the most important part. Like the thing that I know is like, I mean, I've traded the heat maps for long enough where I'm like, all right, if I look at it, I'm like, and I'm looking at these levels, I'm like, yeah, there's a high probability of it reversing there. I'll also show you one thing. Like if you look at the SPY, the range on the SPY for the day was 670 and 660, right? And remember what I said. Like I always said, use SPY, QQQ, and SPX all as confluence. So if you looked, we had a range from 660 to 670. So even at this level, like even if it got down to 66 to 120, like your risk to reward here would effectively be something like this. Like even on the SPY, you could have a risk to reward of like 8.42, okay? Who the fuck is drawn on my screen, man? Like, all right, I gotta find out how to fix these zoom settings. This is crazy. Yeah, so all right, I'm just like flabbergasted right now, sorry. All right, so one other thing was on QQQ, like even though it was dipping, like one thing that we had was a major level here at 605. And generally what I tell people is like if price goes below a particular level, like eventually it's gonna go ahead and revert back to the mean if that 605 is still there, okay? So all right, hold on. Disable annotation during active screen share by clicking more disable participant annotations. All right. Now I won't even be able to share this recording. So whoever drew on my screen, like you guys can all thank them for not being able to share this. All right. Anyways, that's pretty much okay, I kind of lost my train of thought, but that was like a good reversal setup on the SPX and the SPY and everything like that. I'll go ahead and show you how the heat maps actually played out, like going from the perspective of SPY this time. All right. So let's see. On SPX, we hit 6630 at around. um, all right. So it was right around 1202 that we hit it. Let's go ahead and look at what SPY looked like at 1202. All right. So see what I'm seeing here, right? So you've got like a pretty good node down here at 660, and then you've still got the 670 that's alive. And remember what I said earlier, right? Like if there's a node that was very, very strong up here, like as the price diverts away from it, naturally because the deltas on that are dropping, the dealer exposure does not need to be as high for this particular strike as the price gravitates away from it. But what's going to happen if this 660 results in a reversal and unwind back to the upside? Naturally, because these positions at the 670 are still open, as the price reverses and starts going back up to it, like this is going to go ahead and gain strength and watch it gain strength over time. Like if you caught the reversal, okay? All right, so it caught that. So look at this now. All right, it got above the 663, but then look already, like that this 670 has been growing, okay? Like it was at like 55, it was at like 55K earlier. It might have even been lower. Like let's see. So the lowest it got was like yeah, I could have sworn I saw like 43 mil or something like that earlier. But yeah, long story short, like it went from 48 mil to like, 84. So it almost doubled in size, like even though we're only at 663. So long story short, like you see this gaining edge. And like as long as that's gaining edge, like, you're like, okay, like, okay, look at that. Like it's growing very, very fast. So the pace of growth on the 670 and like the diminishing value of the 660 here tells me that the bias is shifting in the direction of the upside. Okay. There's a lot more factors and mechanics involved that results in a natural drift to the upside after around lunch hour happens, which is called the charm drift and the Vanna drift. You can learn about that in the Greek's Bible that I share and like the SPX sniping sheet that I'm gonna go ahead and share afterwards. But just know, after lunchtime, if there's volatility compression, naturally as a result of charm and Vanna drift, you're gonna get you're gonna get delta decay, which ultimately results in dealers buying back. So you're like you just end up in natural like drift upwards, like even if there's people doing literally nothing. All right. So you got this, like, we keep on fucking around that level, but like, you see this is like 98, it's hitting 100 mil and like 124 mil. Like, look at this, it's 124 mil now, and we're still 5 points away from it. Like at this point, like there's no reason for like leaving the trade, especially with the 660 diminishing down to negative 76 mil, okay? Like now you've also got like, a positive node support here at 663, and you've still got 5 points of potential upside. All right, now they're trying to establish a support at 665. So you've got 663 and 665, and the 670 keeps on growing. All right. And yeah, remember the negative zones. Like if it's able to reclaim these, like it's gonna move through these nodes very, very fast. Remember what I said with negative nodes, they're fuel on fire. So if it's able to go ahead and clear that, like it's gonna go ahead and shoot through it really, really fast. This 660 node down here is like nowhere to be seen now. Like this is completely out of the picture. So there's not really any bias to the downside right now. And like you could literally just ride this thing. Like you could ride it 665 is like a very, very strong floor now. So even if price dropped from 666 down to 665, this is a major negative Gex pit. And what that's going to result in is if the price goes down there, people are closing these puts out again, dealers buy back, and then you naturally get reversals to the upside again. And then I think right here, like you just got a major squeeze at this point, and then you ended up closing at 670. So like this is look at this, 492 mil. And not only this, like let me actually show you what else you could have done as well. All right. So not only can you hold to hit that level, another thing you could do if you're a scalper is you could draw a level at 670, right? You draw a level at 670, and like you could play that rejection, you could play this rejection, you could play this rejection. Like actually the third one you probably don't want to trade. Like I usually stop after the second one because the third time there's a 33% chance that it reverses, which means that there's a 66% chance that it's gonna go ahead and break through. But like even these reversals, like these printed 100% because it's this late in the day. It's like 3:12 in the day. So you can easily catch these and play off of these as well. So you could just see how well the levels are respected throughout the day. And the reason why I always tell people to trade the node deflections is because those upper nodes are still there. The reason they're just not as bright is because the deltas on those contracts are not as strong anymore. So like the dealer net notional exposure is just not as strong. But that doesn't mean that it can't grow back, okay? If the reversal happens and you get a buy loop, then those upper nodes are going to grow back very, very strong and fast, and you're going to end up in a squeeze situation like we did on Friday. All right, so that pretty much covers it. Like, I mean, we got 3 minutes left, so I can go ahead and cover a few questions that we have in the chat. I was ignoring them for the time being because there was just a lot of weird stuff. But yeah, so am I buying the 6330 call? I don't think I'm buying the 6330. That's like very, very low. If you maybe you meant 6630, and in that case, it really depends on like who you are, what size your portfolio is, and what you prefer. Generally, when I'm scalping, if I expect a very small range of movement, I will go ahead and trade in the money or at the money contracts. If I expect a gamma squeeze kind of move, like on Friday, like I'll go out the money for like a dollar or like $1.50. Because like, we trade gamma because like it gives you like an exponential advantage, right? Like if you're able to catch a squeeze after a reversal, like the gamma multiplier on delta, like that's generally how you get like 500%, like 1000% plus trades, okay? So it ultimately depends. Like my rule of thumb for like lottos, which like all of my SPX 0 day expiration trades are, is just catching contracts that are like $1.50 or $2 max. If I want like a hyper lotto, like I'll do like a dollar or like $1.20. But ultimately, like that's generally the range that I recommend. So that's just my personal opinion. Like I know some people that trade much larger portfolios. What they do is they trade at the money and in the money, like 100 contracts each. And what they do is they just scalp like 10 to 15% moves. So it ultimately depends on like what situation you're in. Like I can't give suggestions and recommendations on like what strike you should be buying. Like you need to figure that out on your own. Um, that's like that's just like options 101. Like you have to figure that out, but I'll explain to you like why somebody would trade in the money versus at the money versus out the money. Yeah, I think somebody asked, you want to do September 16th, 2025. Yeah, let me go ahead and mark that down and let me see if we have time after all these questions to go over it. One second. I mean, zigzag, there's not really a way to check if the position is still open, but that 670 node always had like exposure on it. Like it always had like positive exposure on it, so you would know that some positions are open. Like you just wouldn't know how many are open because the net notional exposure is changing because the deltas on that contract are dropping. But that doesn't mean that the quantity of contracts has dropped. Like that's the part that you have to understand. Yeah, if there wasn't a potential trade or play that wasn't identifiable, like that's also normal. Like you don't have to trade every single day. But one thing I know is that Thursday was an incredible day to trade. So if you missed that one, then you probably got to go do some recap. Like Thursday and Friday were like two of the best days to trade in my opinion. Yeah, I mean Zigzag, bro. I don't know who the Zigzag guy is, but if you're in Discord, if you're in the Asgard server, like you gotta go read through the docs, man. Like if you read through the docs, like you would know like why the diminishing and growing shouldn't scare you as much because we preach trading reversals and deflections off of the nodes for a reason. Because what we're expecting is that after a node deflection or reversal happens, the tides are going to shift and you're going to see exposure start to grow on the other side because we're going to get a regime shift. Okay? Like just trade node deflections. Like it's as simple as that. Like I don't tell people to chase nodes because ultimately if you chase and you get caught in a regime shift, like you're going to get fucked. All right? So I think some people just gotta read the docs a little bit more and try to explain like why I preach the way of trading that I preach and why I tell people to trade no deflections and reversals from them. All right. Yeah, the negative nodes are also hard resistance at 667 and 667.5, but like why would you be hesitant to buy upside at 661 or 660, bro? Like, I mean, like if you're being taught to trade deflections, like you don't need to chase at 667 or 667.5. Like you just trade the deflection and then you hope for a buy feedback loop to happen, right? Yeah, the 660 negative king gave me a feeling that it's going to deflect for sure because it aligned pretty well with the 6630 node on SPX. So when you've got two to three areas of confluence, then you just take the trade. Like there's nothing is 100% certain, but I take probabilities, and that's like a 66% or 67% of a bounce, then I'll go ahead and take that. Yeah, again, Fence, like I don't know how long you've been utilizing the tool or if you've been going through all the documentation that we're sharing, but just remember that purple nodes, yeah, they could be gatekeepers, but at the same time, like if it clears it, then you're gonna get a spike and it's gonna go ahead and squeeze through. Like one thing you've got to notice is that like the VIX was pretty much getting crushed the entire way that SPX was going up. And when volatility goes down, you naturally have delta decay, which means that hedges are going to get unwound and like the buy loop is going to happen a lot faster because the dealers are able to cover their short shares a lot faster. So you kind of have to like understand like all of the dimensions to this, which is like why I tell people to just like read through everything. Like it's just not simple to cover in a 1 hour session. But like ultimately, if you just follow my follow my advice and like just buy the floors, like you're fine, man. Like if you buy the floors, like your risk to reward is so good, like your drawdown is not going to be negative, and like you'll be fine regardless if you don't hold the full way. Like I'm not saying like you should buy at 6630 and hold 100 points to the upside. Like the thing that you want to aim for is very, very low drawdown and getting like good trade management, like just being able to get out green. Yeah, index confluence and what to do if one of them is diverging. Like I think if one of them is diverging, it's fine. Like if you get 2 out of 3 hits, like that's still 66%, which I like. But for example, if SPX and like if SPX is showing upside, if SPY is showing flat, if QQQ is showing downside, like that's a bit of a coin toss, and like I just don't have as much confidence in that. So those are things I'll be careful for. But if you give it enough time and if you wait, then generally they will start to show alignment and it gets a lot easier. The Greek that impacts the most when price is moving, but premium isn't moving as much. Are you talking about theta? It could be theta or it could be it could be IV as well, like Vega, IV. Because like if the price is going up and you're in calls, but then volatility is dropping, your premiums effectively start to evaporate. So the move needs to happen a lot faster than the IV or Vega of the contract dropping. No, I don't use volume as an indicator at all. So do I take basis on volume? No, I don't. I don't really care about volume. I don't think volume matters as much anymore. Yeah, generally, like for the way I use, so if you're waiting for VIX and double VIX direction, like, I think a lot of people wait for it to show its hand first. But personally, like, I think a lot of the indicators that I use are leading in nature. So generally, like, I am kind of like 2 or 3 steps ahead. Like, I will literally say, like I would be able to call out a VIX reversal before it even happens, just based upon price action, which is why I say price action is king and is the number one thing that you really have to focus on. So I still encourage that. And like I don't remember what VIX looked like on this particular day. Let's go ahead and see. I mean, I don't even know if like the VIX is chartable to be completely honest, given it's a volatility index. But yeah, you've got like resistance right here. That's where it rejects. But ultimately, like I just rely on like for me, like I like to use my hollow candles as an area of confluence. Like if that's happening is like SPX is dropping into like a major negative Gex zone, like for me, that's a go. That's just my own personal way of kind of predicting and forecasting. Oscar, how about you do September 16th, 2025? How about you share your screen and show us? Yeah, I'm not gonna post the replay anymore because people scribbled all over my chart. Yeah, Charbs, the net vex for 0 day expiration only matters if we're still in a high volatility regime, right? And at 130, like I mean, let's see. Like this was the peak in terms of the VIX that day, and then at 130 it was pretty much done. Like it died. Like this is 130 right here. So for me personally, like I expected Gamma to take back over after this initial reversal happened. Like everything from a PA standpoint for me shows that like VIX is on the way down. Like you even get a golden zone bearish retracement here to the downside. And if you look at it, it's like you've got a high here, you've got a low, you've got a lower high, and then you've got a lower low. So for me at 130, like I already know that we're not gonna be an event driven regime anymore, and Gex is gonna take back over. So you don't really have to look at the net VEX at 130 for SPXW. All right. If you read my manual, what I say is that, Gex dominates like shorter term intraday flows, and Vex takes the wheel, but very, very rarely. And it will do it if you get a squeeze like this on the VIX. All right. I mean, SPY is just a derivative of SPX, so QQQ. I mean, I don't know how to answer that question. QQQ has a lot of influence on SPX, but you can't say then SPY because SPY is just an ETF that's a derivative of SPX, right? How do I create a hollow candle in VIX? It's just an algorithm that I have that I use for it. It's nothing special though. You can experiment with like whatever indicators you like. Like I don't really suggest anybody to use indicators to begin with, but like for me, I like to use like, linear regressions, polynomial regressions, and then I look at the second deviation and like the third deviation bands, and when it generally expands past that, I look for a mathematical reversal. It's like a mathematical based algorithm that I use. How do I track vol for individual stocks? I have a formula and I have an internal like tool that I use to track that. I will look to productize that soon so we can get volatility for individual stocks and also so we can measure like volatility skew and IV skew for individual stocks. But I'm not really sure where on the roadmap that is. That might be in like Q2 or Q3 of next year. And once we have that, it's going to add a whole different dimension to how we trade. Joseph Palakil, that answer is in the docs, so just go read the docs, please. I think we're a little bit past time, so I'm not going to answer every single question anymore. Yeah, 6630 plus minus 5 points is what I mentioned in the docs as well, iPhone. Man, all y'all just need to go to the doc site and just read, or you wouldn't be asking these questions. Like, no offense, but like when you ask questions that are already in the docs, like it's just disrespectful for all of the docs that we wrote. Like we do this so we don't have to answer the same question over and over again. So, if you ask me a question that's in the docs, like I'll call you out for it. Like you should go read it. Yeah, it's plus minus 5 points, man. That's how I look at it daily. Otherwise, I wouldn't put it in the docs. Like anything I document is literally coming from how I trade. So just try to look into it and understand it, and that will help. Yeah, Sriram, I have a hold on, let me see if I can pull it up real quick and maybe you guys could take a look and let me know some feedback. 1 second. Yeah, so this one, we're testing it right now and like we might release this one soon, but this one is like a day trading like Trinity view. So based upon like, people that want to day trade, like you can open up SPX, SPY, and QQQ all in the same map. And this is going to help you kind of keep an eye on all three at the same time while you're day trading. So this should be helpful. I think the only thing that's going to suck is that you won't be able to keep an eye on like 0 DTE VEX, but like 90% or like 80% of the time, like the VEX doesn't really matter for 0 day expiration. All right. Yeah, we're testing some stuff. Like we're always like, by the way, like you don't see things hit production very fast, but the reason you don't see it is because like I literally test every single feature that we launch, like personally, for like a week or two before I release it to production. Like I will never release something to to users like if I haven't used it myself. Like that's generally how we keep the user experience as sharp and good as possible. So like you're gonna have to wait for a lot of features, but like just know that there's shit that's always coming in the background that we're working on. Yeah, Joseph, for stocks, it's going to be different for whatever stock you're trading, and it's very dependent on liquidity for that particular stock. Like Nvidia and like Tesla, might overshoot anywhere from like 2 to 3 points. But then if you got a ticker like, Iron or like, maybe even like Hood or something like that, like it could overshoot a little bit more. Um, like one thing that okay, so there's a couple of things that I have to share before we hop off. These are very, very important things, okay? The risk management aspect of SPX is very, very critical. Okay. So the rule number one that I have is like your size should be your stop loss. 0 day expiration trades, you can lose like 50 to 80% of the trade on the trade instantly. Later in the day, it's even riskier. If you're trading in the last 30 minutes or an hour and you're in like a 50K position and you're like, oh, I'm going to stop out at like, a 10% loss, you're not going to be able to do it. You're going to enter the trade, you're going to go down 10%, you're going to be like, fuck, I need to sell it, but you're going to freeze up. Like your brain is going to freeze up because your brain is telling you that the move in the direction you're expecting is supposed to happen, but your contracts are down 10%. So you're gonna freeze up and you're gonna end up in the situation where you're like your head is telling you that you're right, but then your contracts are telling you you should stop out. So as a result of it, you're gonna end up holding in bag holding. Then it's gonna be down like 30%, then it's gonna be 50%. Then you'll be like fucking panicking and you'll sell it. And then what it's gonna happen is it's gonna move in the direction that you intended it to move. And then if you hadn't sold it, you would have made like 300 to 500% on that trade. This happens very, very often. It's gonna happen to you unless you listen, okay? So for 0 day expiration trades, instead of taking a 10K position and telling yourself you're gonna put a 20% stop loss on it, take a $2,000 position and don't use a stop loss. Your maximum potential loss is still gonna be the same. But with a $2,000 position, you're actually giving it time to play out according to your hypothesis, okay? Like for 0 day expiration trades, like you simply have to give them room to breathe. Like you have to give them room to breathe. And like they whipsaw, the premiums will whipsaw like crazy, okay? Like I can't tell you the amount of times somebody has come to me telling me they took a 50K position in 0 day expiration SPX and they stopped out for a 25K loss. And if they held it, they would have been up like 100K. Like this shit happens all the time. Like these rules are here for a reason. If you can't or if you don't know how to size for 0, like do not even start trading SPX 0 day expiration, okay? Like like you just can't use stop losses on these things. Otherwise, you're gonna get stopped out left and right and you're gonna have a win rate of like 10%. All right? Rule number two, don't ever chase when you're trading SPX. Like, wait for pullbacks, trade reversals. What this means is in the positive exposure nodes to the upside, you should fade the move, which means as it's approaching it, you should enter like puts or something like that. And also like in the negative reversal levels, like don't fucking chase after like a 30-point move or a 45-point move. Like if the reversal happened and it's already up like 20 to 30 points, you missed the move, okay? Like don't ever chase through the midpoint because that's where like a lot of hedging is going to start rebalancing. So you're going to end up in chop or you're going to end up in a mean reversal, okay? Like just be very, very careful with chasing for 0 day expirations. One thing that also sucks when you're chasing is that like you're buying into elevated premiums already because like everybody else is chasing with you. So you don't want to be part of that herd, okay? Like just be very, very careful. So I will go ahead and share the document. Like I'm gonna go ahead and like brush up on the document a little bit more based upon a lot of these questions that people are asking, just to make sure I have a very comprehensive view. But I'll probably have it out like later this week. I just need to think about how I'm gonna share and where I'm gonna share it. Release the Trinity now. Yeah, I've got to test it out a little bit. I'll take a look. But yeah, as you're seeing, like we have functionality to show all 3 charts at the same time. But also what we've built out is the ability to identify where the king node is, how many points away it is from spot, and how much percentage away it is from the spot right now. So now we're able to kind of track nodes relative to the current price. Like we have the backend mechanism to do that. So there's a lot more cool stuff that's going to be coming. Yeah, I mean, RSL, like that's a interesting question. Like, the 660 negative node gave me confluence with the 6630, but both of them give me confluence because SPY was at like 661, which is only 1 point away from like a bounce zone. And SPX is like at 6630. So, SPX plus minus 5 points, like it might have dropped down to like 6625 or even 6620. But I was fine like holding that for a very long time. Like it was pretty damn near the bottom of the range. How long do I stay in a trade on average on 0 day expiration? Probably like minutes. Like if I have runners, then sometimes I let them close and settle, but like generally like I'm in and out within like a few minutes or like 10 to 20 minutes. Yeah, like anybody that talks to you about 0 day expiration, like the people that talk bad about it are generally the ones that don't know how to trade it, that have very, very poor experiences with it, okay? Like if you follow the rules that I have, you will be fine, okay? You will be fine. Just size for 0 and like just practice with like very, very small positions. If you don't want to trade SPX, like you could trade SPY. But like just remember, like it's all about like sniping. Like the reason why this is a sniper session is like you have to be like very, very precise and you have to be very, very disciplined with like the shots that you're taking. Like don't rapid fire. Like there's only two or three very, very good setups every single day. That's why I always tell people if you missed the first setup, if you missed the second setup, just don't do anything. Like just sit on your hands and like don't do anything, okay? Because there's generally only two to three really, really good moves in the day. Yeah, DJ, like I said, I didn't really say don't trade in the first 30 to 45 minutes. Like if you're new, I just don't recommend it because it could be very, very trappy during that first 30 to 45 minutes. But like if you have a hard rule where you're like, I'm never going to trade in the first 30 to 45 minutes, like you're going to miss generational opportunities. So like I don't have any like absolute hard rules. Like if everything is aligning and I'm like I can catch a 100 point move to the downside, like I'm still going to fire my shot even if it hasn't been 30 to 45 minutes yet. Yeah, you gotta fix the FOMO and greed, man. No FOMO and greed in trading, and you'll be fine. Thomas the Train, how to tell if the price is going to break out the resistance or it will hit and reverse when it's getting really close to the king node? Well, generally, like yellow is like a lot more suppressive in nature, so it dampens volatility. So if you're in a low volatility regime and the price is approaching a yellow node, like you fade that. That's just like that's dealer mechanics. Like you have to understand what the dealers are gonna do as these nodes are approaching, and if you want to be able to do that, just go redux. You'll be able to have a pretty good understanding. How much percentage do I believe the Gex ranges in that day? I don't I don't know if I understand the question. Like you might have to elaborate a little bit there. Yeah, I don't really wait for opening range. Like I know a lot of people trade like opening range breakouts and breakdowns and stuff like that, but I just never really thought it gave me that much of an edge. Like the way I trade, especially for 0 day expiration, is like if I have not sniped the absolute low or the absolute top, I don't want it. Like your entry is so important when you're trading 0 day expiration, and I cannot elaborate more. Also, another piece of advice for the 6630 and the 6640 earlier, if you want to go ahead and front run the move, you can. So if it's like 6635 and you're like, I don't want to fucking miss this move, like you can enter a smaller position there. You can enter like a 20% position or a 25% position. Then if it goes down to 6630, you can scale in to be in like a half position or like 60% position. If it goes down even 5 points below it because SPY wants to pull all the way down to 660, at that point I would take a full position. Okay? So that's kind of like the scaling entries method. Like this is not averaging down because generally when people are averaging down, what they're doing is they're going into a full position already. They go underwater, and then to bring their average down, they're going to double down or they're going to triple down. That's something called a martingale strategy, and that's not what I recommend. The scaling in strategy is where you have a set amount that you're willing to risk on the trade, but your initial entry is only 20% of that, and then your second entry brings you up to like 50% of that. Then your third entry brings you to like 70% of that, or something like that. And by the end of all your scaled entries, you should be damn near the bottom of the Gex range. And at the same time, you should be in a full position at that point. The way you should kind of think about these negative Gex reversals is if the price drops below it, think of it as having a beach ball and you're pushing it deep, deep down into the water. You can only keep it down there for so long, and if you let go of it, it results in a trampoline effect, right? Where it just freaking explodes back up to the upside. This is a very, very common move that happens when you have those negative Gex pits and the price is falling into it. The only way this works, though, is if volatility compresses. Okay, like that's the most important part. Like this is the important. One of these days, like somebody's gonna see that purple node, and they're gonna be like, "Fuck it, I'm gonna buy the dip there." They're gonna buy heavy, and then it's gonna just slice through it, and then they're gonna be like, "What the fuck happened?" Go look at the VIX, and I bet you it just fucking blew past where it was. All right. Yeah, I mean, technically you can chase nodes. It's just like I just never encourage chasing because like you're not getting the best entry. But if the major node is showing like a clear like 1% or 2% drop on SPX, then yeah, that might be worth chasing. But like just be careful. Like just don't, chase heavy. Yeah, the strong nodes that open, there's a high probability they come back later in the day. Like if they completely diminish, that's a completely different story. But a lot of times, like they stay open. The reason they diminish is because delta is decaying, so like the hedging obligations are not as strong. But if the price eventually reverses and starts going back towards it, you can easily go strong because the positions there are still open. Did I ever get Gex range obsolete in a day or my trade went south? I don't know what that means, but yeah, I have a lot of trades that go south. But again, like your goal is not to have a 100% win rate, it's to have bigger winners than your losers and like give yourself the room and space to be wrong. Rick? You think, do I think it's Rick? Oh, so what you're asking is if the price is dropping down to 66.30 on SPX, is it okay to open a bull put spread below that? And my answer is yes, it is okay to do that. So, a lot of people that prefer a much more conservative strategy. What you could do if you're expecting a reversal from 6630 and SPY 660, what you could do is you could do a bull put spread, which is like a credit spread on puts. Just make sure that you're giving yourself enough cushion. Like just, put it at like put your legs at like 6600 and 6610 or like, 6620 and 6610 if you want to be more aggressive. But effectively like just give it enough cushion or room. That way like you don't blow up. Like with the thing with like bull put spreads is like your win rate has to be like 80 to 90%. Otherwise, one loss is going to wipe out so many games. But they do work well, especially in high volatility regimes. It's even better because you're able to cash in a lot of premium. So yeah, you could do bull put spreads or you could do bear call spreads. For example, like if SPY is tapping near 670, then you could take a bear call spread at like 673, 675, or 673, 674. There's a lot of different strategies you can employ, and that's all up to you guys. Yeah, you can. Ritesh, there is somebody in our chat that literally does bear call spreads and bull put spreads all day and like they cash in like 10 to 20K a day. It's a very good strategy. Like you just have to know what you're doing. I could probably cover that in a different day. Like I think there's a lot more other sessions I have to cover, but yeah, the spreads is you can play it. I don't know, man. Go ask in the questions channel and go find the person. There's like 1,100 people in there. It can't be that hard to find them. I don't remember all the names, but if you check in the profits channel, you'll find it, brother. All right. All right, we're over time, 26 minutes. So I'm gonna cut the recording and I think I'm done for the day, guys.